However, my next guest has just offered up $315 million in new lines of credit to firms in this mid to small category. Joining us now to talk about this is Lee Wilson. He's the chief executive of First Capital. Lee, good to have you with us. Thanks so much for coming into the studio. You're based in Boca Raton, Florida. For those that don't understand what First Capital does, you're owned by a private equity firm.
Yes.
You've raised your own capital,
right,
and you're trying to step into that role that maybe traditionally was filled by a bank. You've described it as almost having lender fatigue. What is that?
Yeah. Well, we're a working capital lender, basically, and we have common equity of about $200 million. We're just a little under $1 billion in terms of total assets. What we do is we lend against working capital, receivables and inventory for small to mid-sized businesses. Sales of $10 to $100 million is sort of our bread and butter. And we typically are an event-driven lender. So if that means that there's lender fatigue, usually caused by losses, and the bank wants the lender out, we go in and we back management teams that have got a turnaround plan that we can believe in. We also help companies that are having rapid growth. Banks don't like to lend to people who've got too fast a track record. They want to see a longer period of proven success. And then a third thing that we do is when there are acquisitions. There are a lot of PE firms that do lots of deals, and we're oftentimes involved in those.
Now, as someone that has this private equity backing, do you also get involved in the operations of the company, either helping them with new markets or helping them expand their operations?
We do not. We're strictly the working capital lender. But we do get very involved in understanding the business plan. Because if a client doesn't have a business plan that we can believe in, then it's not somebody we want to lend to. Example, we have a client we picked up in the last year, and they're a commodities distributor. And they had gone into a new line of commodities. Didn't work out so well for them, okay? So they had a loss. Their bank didn't want to deal with them anymore, so they were pushing them out. We looked at the plan, said, you know, they really know their old business with the commodities they were distributing better. If they're not going to be in this new one, there's no reason that these guys shouldn't be profitable. So we backed them, gave them the lines of credit, and they're back in business making a lot of money now.
How do you go about the process? You said, you know, looking at accounts receivable as well as inventories. Do you have to go in and put valuations on those as well?
Absolutely. We do exams on a quarterly basis where we go in and take a look at that, but we also have all the cash for our clients comes into a lockbox, so we have a perfect view into what's happening in terms of their cash flow on a daily basis. So it's an interesting situation which gives us insights into what's going on in the marketplace. What's been observed in middle market lending is people say that banks aren't lending. You know, loans are going down, they don't want to lend, and that's sort of,
they can't refinance.
Yeah, during the recession, our loans from clients that have not left us but have simply had less sales have gone down by 20%. The reason for that is if you have lower sales, you have lower receivables and inventory. You don't need it. I suspect there's a certain amount of the bank decline in loans that's driven by the same thing. But we are seeing, I'm not ready to predict an inflection point at this juncture, but we'd seen a steady decline in terms of borrowings from clients, and now we're starting to see some turnaround in terms of borrowing.
Now, as I mentioned, corporations such as Google and Johnson & Johnson tapping the bond market, paying very low interest rates. What about the cost of this money to the companies?
The cost of our money?
The cost that they have to pay you.
Yeah, exactly. Yeah. We're a lender that's anywhere between LIBOR plus 6 and 8. We have other fees and the like. We're not an inexpensive lender, but we're providing the availability for growth. Another example, temporary services company, growing very rapidly, as you can imagine, in this kind of an economy, had outgrown their regional bank as a lender, and as a result, we stepped in and were able to give them the working capital to continue to grow and make money.
All right, we're going to leave it there, but I want to thank you very much, Lee Wilson, First Capital, sharing your insights into middle market lending and origination. Thank you very much.